Welcome to the Sykes & Company PA video blog featuring Ollin Sykes.
Ollin, I understand that Congress just passed a substantial tax bill right before Christmas. Can you tell me how that impacts pharmacy owners?
The impacts to pharmacies retroactive back to January 1st of 15, that's retroactive back to January 15, primarily relate to depreciation, and that the what's referred to as the Section 179 depreciation limits are now $500,000 with a $2 million phase out. And that actually goes into 16 and years thereafter as well. So they've actually not only extended that retroactively, but expanded that into this year and years thereafter. The phase out is if you have asset purchases of more than $2 million and that $500,000 amount starts to reduce. That doesn't impact too many pharmacies from that perspective. But where this does impact pharmacies dramatically is with the technology updates, with the purchase of the script management systems, with obviously robots, pill counting machines, any type of technology improvements that many pharmacies are going through these days to try to limit gross salaries they're paying out. This has a tremendous impact. We had planned on it occurring for the year, so we were. I can't say we were lucky, but it was beneficial that it was passed because it impacted a tremendous number of pharmacy clients that we had for last year. In addition, there's another provision. It's called Section 168K, which deals with 50% depreciation for new assets purchased between 2015 and 17 inclusively. I might add that the Section 179 deals with both purchase of new and used assets. But there's some limitations if you get into a loss situation with respect to the 179. But the 168K provision deals with the purchase of new assets. So between these two major provision changes or updates, as the case may be, these have a tremendous impact on pharmacies for 15, 16, and into years thereafter. So there's plenty of planning that can be done for 16 and years thereafter. There's also retroactively work that can be done for 15, which is a very good thing for most pharmacies. Also, on a separate but yet very important note, for those pharmacies that are looking to potentially sell their pharmacies in years out into the future, there is a permanent provision. There's a provision that's now permanent that if an entity was taxed as a C corporation and they had made an S election in recent years, there was previously a 10-year window that they had to be an S corporation before they were eliminating the tax on what's referred to as built-in gains. And built-in gains essentially was the fair market value of the assets at the time that a C corporation made an S corporation election. And since so many pharmacies are taxed as S corporations, and a lot of them have changed from C to S corporations in recent years, and had made and had built-in gains that could potentially be double taxed. The new provision makes permanent there's only a 5-year waiting period for that now to occur rather than 10. I know we've got several clients even for last year that impacts us dramatically on. So the planning point there is if you have been a C corporation and you've made the S election inside of 5 years and you have built-in gains when you made that S election, this could impact you dramatically upon a sellout because it would eliminate a tremendous amount of potential tax there. Also, we work with a lot of pharmacies that have higher incomes, and in recent years we have gotten into conservation easement investment / deductions for a number of these pharmacies. These are programs where investments into Pacific limited partnerships are made, and instead of the properties being developed, they're actually given away as a conservation easement. And there's some tremendous benefits that apply to those kinds of, I refer to as a tax replacement tool that can be used through these deals. And Congress made a major change in that particular area that allows you to have conservation easement contributions of up to 50% of your adjusted gross income, up from the old law of 30% of adjusted gross income. I know that impacts a number of our clients in 2015 and will in 16 as well. Also, there were a number of extensions and modifications to the Work Opportunity Tax Credit, and that's a credit that's available on an elective basis for employers hiring certain individuals from one of 9 different targeted groups. The planning point there is when you're potentially hiring somebody, whether they're a vet, whether an unemployed person, whether it's somebody on a social service assistance or something of that nature, you need to get the certification very quickly. In fact, I believe it's within 30 days after you hire that person, to make sure that you get that tax credit opportunity. And lastly, one other point that I would bring up, for those pharmacies that are looking or have invested into real estate or leasehold improvement updates, there's a lot of action going on in this particular area with respect to what's referred to as cost segregation studies. And this is where you may do an update inside of a pharmacy. Instead of getting the usual 39 and a half years straight line depreciation, you can go outside, get a cost segregation study, and get the component parts of that broken down so that you can appreciate a lot of it 5-7 years. There is a cost benefit analysis that has to be run on that. If it's a few $100,000, it probably isn't beneficial to go through that cost segregation study. But if you're looking at $500,000 to $1 million or more, then you clearly probably do want to consider something. And I know a lot of pharmacies are continually updating their properties and plant and facilities, and that's something they need to look at. But those are some things that are kind of hot and heavy right now with a lot of our clients, pharmacy clients specifically, and I just thought I would point those out to you.
Thank you for joining us today. If you want more information or have any questions, please feel free to contact Ollin directly.